The cryptocurrency world is no stranger to controversy, but the latest revelations surrounding Ethereum might just take things to a whole new level. Rumors of a 60 million bribe scandal have sent shockwaves across crypto communities, shaking the foundations of trust in one of the largest and most influential blockchain ecosystems. Today, we're diving deep into the heart of this explosive story, examining the players involved, the mechanisms through which such a scandal could have taken place, and the potential consequences for the Ethereum network and the broader crypto market. It all began when several anonymous sources claimed that an influential Ethereum developer and a few associated parties had been implicated in a secretive bribe scheme involving massive amounts of ETH. While the identities remain partially obscured, leaked transaction records and internal Discord chats suggest that millions of dollars in Ethereum were transferred through complex channels to incept decisions favorable to specific stakeholders. These transactions weren't simple wallet-to-wallet transfers. They involved multi-signature wallets, smart contract loopholes, and cross-chain bridges designed to obfuscate the flow of funds, making it extremely difficult for ordinary users and even some analysts to trace the money trail. The bribes reportedly aimed to influence governance decisions within Ethereum's ecosystem, including protocol upgrades, validator approvals, and project fund allocations. If proven true, this would mean that decisions intended to be decentralized and transparent were subtly manipulated by a handful of insiders, creating a centralized power dynamic that undermines the ethos of blockchain technology. The first signs of irregularities appeared when Ethereum developers noticed abnormal voting patterns during recent protocol improvement proposals, or EIPs. Certain proposals that seemingly had little merit were passed with overwhelming support, while others with broader community consensus were delayed or rejected. Analysts began digging into on-chain data, and that's when the mysterious 60 million trail emerged. Using blockchain forensics tools, investigators mapped out a network of transactions that appeared, on the surface, to be unrelated payments but were intricately connected through a web of intermediaries and layer smart contracts. These payments coincided suspiciously with key votes and decisions within Ethereum's governance structure. Social media exploded with speculation as crypto influencers, podcasters, and Reddit threads dissected the findings. Many argue that if the scandal is true, it could irreparably damage Ethereum's reputation just as it continues to face competition from emerging Layer 1 and Layer 2 solutions. Ethereum's core philosophy has always emphasized decentralization, transparency, and trustlessness, principles that would be fundamentally challenged if insiders were manipulating outcomes for personal financial gain. In response to the uproar, Ethereum Foundation representatives have issued cautious statements, neither confirming nor denying the allegations but emphasizing their commitment to integrity and urging the community to await verified findings. Meanwhile, blockchain investigators and whistleblowers continue to provide pieces of evidence, including screenshots of private conversations and transaction logs that suggest a premeditated effort to sway Ethereum governance decisions. The scandal also raises pressing questions about accountability within decentralized networks. How can a blockchain designed to prevent manipulation be exploited by those with sufficient technical knowledge and financial leverage? Critics argue that this incident underscores the need for more rigorous auditing, transparent voting mechanisms, and safeguards against conflicts of interest in crypto governance. It also serves as a cautionary tale for investors who assume that decentralization automatically equates to fairness. Beyond the immediate implications for Ethereum, the potential 60 million bribe scandal has broader ramifications for the entire crypto industry. It threatens to erode confidence in decentralized finance DeFi projects, non-fungible tokens NFTs, and blockchain-based governance models. Venture capitalists and institutional investors may reassess their involvement in Ethereum-related projects, wary of potential regulatory scrutiny or reputational risks. Regulators, already keeping a close eye on the crypto space, could seize this as an opportunity to push for stricter oversight, mandatory disclosures, and anti-corruption measures. From a technical perspective, the Ethereum community may need to consider implementing enhanced monitoring tools, smart contract audits, and decentralized voting mechanisms that minimize the influence of high-net-worth individuals or coordinated groups seeking to manipulate outcomes. This incident also highlights the dual-edged nature of blockchain transparency. While every transaction is publicly recorded on the Ethereum ledger, sophisticated techniques like layering, anonymizing mixers, and complex smart contracts can still conceal the true intent behind financial movements. Experts suggest that the ongoing investigation will require collaboration between blockchain forensics specialists, independent developers, and even law enforcement in extreme cases. Meanwhile, discussions continue on how to restore community trust. Proposals have emerged to implement more robust conflict of interest reporting, stricter governance participation rules, and mechanisms to flag suspicious transactions in real time. Social sentiment is also playing a role. Ethereum users are voicing concerns on forums, Twitter, and Telegram channels, emphasizing that transparency and accountability must remain non-negotiable pillars of the ecosystem. Despite the mounting evidence, skeptics warn that some claims could be exaggerated or misinterpreted. The crypto world is notorious for rumors and fear, uncertainty, doubt, and distinguishing verified facts from speculation remains a challenge. Nevertheless, the sheer magnitude of 60 million in Ethereum, coupled with on-chain patterns and whistleblower statements, makes this scandal impossible to ignore. If confirmed, it would serve as one of the largest corruption allegations in crypto history, dwarfing previous controversies and forcing the industry to confront uncomfortable questions about governance, centralization, and trust. Investors, developers, and enthusiasts alike are now closely monitoring Ethereum's response. Will the foundation take decisive action to investigate, disclose findings, and reform governance mechanisms? Or will the scandal quietly fade as claims are disputed and evidence contested? The next few months could define Ethereum's credibility and set a precedent for how similar incidents are handled across other blockchain ecosystems. For ordinary crypto holders, this serves as a reminder to remain vigilant, diversify investments, and participate actively in governance processes rather than relying solely on presumed decentralization. Transparency, community oversight, and technological safeguards are essential to maintaining the integrity of decentralized networks. In conclusion, the 60 million Ethereum bribe scandal, whether fully verified or partially exaggerated, has already left an indelible mark on the crypto landscape. It underscores the delicate balance between decentralization and centralized influence, the challenges of enforcing ethical behavior in a digital world, and the ever-present tension between ambition, greed, and community responsibility. As Ethereum navigates this turbulent moment, the outcome will likely have profound implications not just for ETH holders, but for the entire blockchain ecosystem, shaping debates around governance, accountability, and the true meaning of decentralization for years to come.